You mentioned the speed of cross-border payments and the opaqueness of that process, and I guess it's also error-prone to some extent with SWIFT. Santander seems to be trying to approach it with a partnership with Ripple. Just curious what your thoughts are on that.
So I do think that of the use cases out there, cross-border is one of the most compelling. We know that intermediation chains cross-border are long and quite opaque, and they're slow, and they can be quite costly. So my sense is that technology with the appropriate safeguards could make a material impact and likely will. And it may well be through a partnership model. I don't want to pronounce on any particular approach, but there are a variety of partnerships out there that are trying to innovate and to reduce frictions and increase transparency for those cross-border transactions. In my sense, I'm fairly optimistic that there are some good solutions out there that don't necessitate a global stablecoin. Well, thank you to Adam for a very kind introduction, and it's always a pleasure to be here at Peterson. There's a long history of technological advances challenging the prevailing notions of money, from the trading of coins to the use of paper currency to the electronic debiting and crediting of funds on the accounts of banks. Today, efforts by stablecoin networks such as Facebook's Libra to establish the next chapter in the story of money are raising threshold questions about legal and regulatory safeguards, financial stability, and monetary policy. Because of its potential global reach, Facebook's Libra imparts urgency to the debate over what form money can take, who or what can issue it, and how payments can be recorded and settled. A decade ago, Bitcoin was heralded as a new kind of digital currency that would provide the three functions of money without the need for centralized governance. Bitcoin's emergence created an entirely new payment instrument and asset class, exchanged over a set of payment rails supported by distributed ledger technology, a shared tamper-resistant ledger that can be updated by anyone with sufficient compute power. But Bitcoin did not achieve widespread acceptance as a means of payment or unit of account due to its extreme volatility as well as limited throughput, unpredictable transactions costs, limited to no governance, and limited transparency. Stablecoins were designed specifically to overcome the volatility of the first-generation cryptocurrencies that limited their utility in payments and as a unit of account. As their name is intended to convey, stablecoins aim to maintain stable value by tying the digital currency to an asset or a basket of assets, such as commercial bank deposits or government-issued bonds. Unlike first-generation cryptocurrencies, they may be issued by a central entity and rely on third-party institutions for some aspects. Just as any currency's value as a medium of exchange increases with the size of the network using it, so too the power of a stablecoin payment system depends on its ability to achieve widespread adoption. In light of the 2.7 billion active monthly users on Facebook's platforms, the Libra stablecoin project stands out for the speed with which its network could reach global scale in payments. To provide context for assessing stablecoins, it's useful to understand established arrangements for the issuance, regulation, and transfer of money. Central bank money and commercial bank money are the foundations of the modern financial system. Central bank money, physical cash, and money held in deposits at a central bank represents a safe settlement asset, allowing users to exchange central bank liabilities with confidence in their acceptance and reliability. In addition, central banks play a critical role as providers of liquidity at times of stress by lending central bank money. Money held in deposits at commercial banks is widely used because people are confident that they can convert it on demand for the liability of another commercial bank or the central bank, such as physical cash. This is because bank deposits are insured, and commercial banks are subject to supervision, regulation, and deposit insurance requirements. Non-bank private money or assets can also facilitate transactions among a network of users. In some cases, such as airline miles, such assets may have value only within that network. In other cases, the issuer may guarantee convertibility to a sovereign currency such that it becomes a liability of the issuer. In those cases, customers trust that the company issuing such money will be able to honor those liabilities. Many U.S. consumers experience non-bank private money already in the form of gift cards, loyalty points, and virtual gaming currencies. For instance, Starbucks reported it had $1.6 billion in stored value card liabilities towards the end of last year, which is more than the deposits of many banks. As the scale and scope of such private networks grow, so too do the convenience and benefit of transacting within the network. These network benefits may be augmented by the active use of network data for a host of purposes, from allocating and pricing credit to sharing reviews to prioritizing information that is pushed to users. In China, consumers and businesses participate in two mobile networks, Alipay and WeChat Pay, which by some accounts handled more than 37 trillion in mobile payments last year. These networks operate within China based on the RMB as the unit of account, and balances are transferable in and out of bank or credit card accounts. Stablecoins may represent private non-bank liabilities depending on their design and claim structure. They aspire to achieve the functions of traditional money without relying on confidence in an issuer, such as a central bank, to stand behind the money. Indeed, for some potential stablecoins, a close assessment suggests users may have no rights with respect to the underlying assets or the system overall. We've already seen the growth of massive payments networks on existing digital platforms such as Alibaba and WeChat, and the issuance of stablecoins on a smaller scale, such as Tether, Gemini, and Paxos. What sets Facebook's Libra apart is the combination of an active user network representing more than a third of the global population, with the issuance of a private digital currency opaquely tied to a basket of sovereign currencies. It should be no surprise that Facebook's Libra is attracting a high level of scrutiny from lawmakers and authorities. Libra, like any global stablecoin project, must address a core set of legal and regulatory challenges before it can facilitate a first payment. Let me touch on a few of these. First, compliance with Know Your Customer regulations are essential if stablecoins are not to be used for illegal activities and illicit finance. Libra's business model is inherently cross-border, and as such, each participant in the system that is a financial institution would need to ensure compliance with each jurisdiction's anti-money laundering laws. Libra's intended global reach would likely necessitate a consistent global anti-money laundering framework in order to reduce the risk of illicit transactions. Second, issuers of stablecoins designed to facilitate consumer payments must clearly demonstrate how consumers would be protected. Consumers will need to be educated on how their rights differ with respect to digital wallets compared with bank accounts. Statutory and regulatory protections on bank accounts mean that consumers can reasonably expect their deposits to be insured up to a limit, fraudulent transactions to be the liability of the bank, transfers to be available within specified periods, and clear standardized disclosures about account fees and interest payments. Not only is it not clear whether comparable protections would be in place in a stablecoin network such as Libra or what recourse consumers would have, but it isn't even clear how much price risk consumers will face since they don't appear to have rights to the underlying assets. The large number of cyber breaches in the last few years highlight the importance of getting clarity on what legal entity can be held responsible for the security of personally identifiable information and transaction data, and how personal data will be stored, accessed, and used. Third, it'll be necessary to define the financial activities the various players in the ecosystem are conducting in order for jurisdictions to assess whether existing regulatory and enforcement mechanisms are adequate. Switzerland is the legal domicile of the Libra associations. In Switzerland, there are 3 new categories to facilitate their approach of regulating by function. Payment tokens are cryptocurrencies that are meant for use in payments or value transfers. Utility tokens are blockchain-based applications, and asset tokens are crypto assets that are analogous to equities, bonds, and derivatives. Here in the US, regulators are closely examining particular stablecoins and cryptocurrencies to determine whether and where they fit in the regulatory structure and whether additional authorities or guidance is necessary. Our market regulators have authorities for products judged to be securities or commodity futures under relevant law. At the state level, the New York State Department of Financial Services has established a bit license for virtual currencies. The Federal Reserve and the other federal banking agencies have supervisory authority over banks, but the Federal Reserve does not have plenary authority over payment systems operating in the US. The FSOC does have the authority to designate systemically important non-bank financial companies, financial market utilities, or payment, clearing, and settlement activities based on the facts of the specific situation. It isn't clear at this time whether any cryptocurrency issuer would meet the statutory requirements for FSOC designation. Fourth, the distributed ledger technology underlying many stablecoins and cryptocurrencies more generally have advantages, but they also have risks. While they could offer advantages by enhancing operational resilience, increasing transparency, and simplifying record keeping, the public and immutable nature of the transactions ledger also introduces risks, such as data privacy concerns and legal complexity. Fifth, widespread mitigation to one or more global stablecoin networks could disintermediate banks. If consumers and businesses reduce their deposits at commercial banks in favor of stablecoins held in digital wallets, this could shrink bank sources of stable funding as well as their visibility into transactions data and thereby hinder their ability to provide credit to businesses and households. That said, many banks are likely to adapt by offering alternative methods of peer-to-peer settlement and by incorporating stablecoins into their business models, whether by partnering with fintech firms who are issuing stablecoins or by issuing their own, as some are already doing. Sixth, widespread adoption of stablecoins could have implications for the role of central banks and for monetary policy. Large-scale migration into a new stablecoin network for purposes of payments may prove to be the leading edge of a broader migration that encompasses the other functions of money. If a large share of domestic households and businesses migrate to a global stablecoin, not only as a means of payment, but also as a store of value, this could shrink demand for physical cash and affect the size of the central bank's balance sheet and the central bank's approach to implementing monetary policy. These effects are likely to be more significant for small open economies or those with weak monetary institutions, where the migration away from the sovereign currency to a global stablecoin could weaken the scope for independent monetary policy through a process that's the digital analog of dollarization. Large-scale stablecoin use could also affect larger advanced economies with extensive connections to the global financial system by increasing market volatility and transmitting shocks across borders. And finally, a stablecoin network with global reach raises financial stability considerations. If not managed effectively, liquidity, credit, market, or operational risks, alone or in combination, could trigger a loss of confidence and run behavior. This could be exacerbated by a lack of clarity about the management of reserves and the rights and responsibilities of various market participants in the network. The risks and spillovers could be amplified by potential ambiguity surrounding the ability of official authorities to provide oversight, backstop liquidity, and collaborate across borders. Even before the advent of stablecoins in some jurisdictions, a pronounced migration from cash to digital payments had already prompted central banks to explore the merits and risks of moving to digital issuance of their own currencies. The potential for global stablecoin systems has intensified the interest in central bank digital currencies. Proponents argue that central bank digital currencies would be a safer alternative to privately issued stablecoins because they'd be a direct liability of the central bank. And you're going to hear later today from Marcus Brunemeyer about his paper, which provides important arguments in this arena. Of course, the Federal Reserve and other central banks already provide money digitally in the form of central bank deposits in traditional reserve or settlement accounts. However, in the current context, central bank digital currency typically refers to a new type of central bank liability that could be held directly by households and businesses without the involvement of a commercial bank intermediary. Such central bank digital currencies could differ from traditional reserves along three dimensions. A much broader set of institutions and individuals could access it. Some types of balances might not pay interest, and it might entail greater government visibility into end users or consumers' transactions. In the United States, there are compelling advantages to the system that we have today. First, physical cash in circulation for the US dollar continues to rise, suggesting there's robust demand. Second, the dollar is an important reserve currency globally, and maintaining public trust in our currency is paramount. Third, we have a robust and diverse banking system that meets the needs of consumers. And finally, we have a widely available and expanding variety of digital payment options that build on the existing institutional framework and the applicable safeguards. Central bank digital currency for general purpose use, that is for individual consumer use, would raise profound legal, policy, and operational questions. Let's consider the balance between privacy and guarding against illicit activity. If it's designed to provide safeguards against illicit activity, a central bank digital currency for consumer use could conceivably require the central bank to keep a running record of all payments data using the digital currency, a stark difference from cash. A system in which individual payments information would be recorded by a government entity would mark a dramatic shift. A related question is whether the Federal Reserve even has the authority to issue currency in digital form, and if necessary, to establish digital wallets for the public. There could also be profound monetary implications. Some economists have argued, probably in this room, that a central bank digital currency could address the problems posed by the zero lower bound by transmitting monetary policy directly to the public. Executing monetary policy in such a manner could imply the elimination of all physical cash and the power to impose a negative rate or a tax on households' holdings of digital money. Those represent dramatic changes. My own strong preference is to address the effective lower bound by using our existing toolkit vigorously, since I view the cost-benefit assessment of negative rates as unattractive for the current U.S. context. Financial stability considerations are also important. The ability to convert commercial bank deposits into central bank digital currency with a simple swipe surely has the potential to be a run accelerant. And finally, there could be operational risks to a central bank digital currency. For starters, this might require the Federal Reserve to develop the operating capacity to access or manage individual accounts, which could number in the hundreds of millions. A myriad of other operational challenges would need to be addressed, including electronic counterfeiting and cyber risks. That said, some jurisdictions may move in this direction faster than others based on the particular attributes of their payments and currency systems. At the Federal Reserve, we will continue to analyze the potential benefits and costs of central bank digital currencies and look forward to learning from our colleagues. While prudence cautions against rushing into untested approaches to central bank digital currencies, we are actively investing in our payments infrastructure so that everyone has access to real-time payments. We announced that we'll launch the first new payment system in more than 40 years to help make real-time payments available to everyone. FedNow will provide a platform for consumers and businesses to send and receive payments immediately and securely 24 hours a day, 7 days a week, 365 days a year. It will provide a platform that's neutral for private sector innovation in new, faster payment services for end users. And we're also exploring enhancements to FedWire Fund Service and National Settlement Services, including expanding office operating hours. As the public and private sectors work to reduce payments frictions, one of the most important use cases is for cross-border payments, such as remittances. Technology enables e-commerce to transcend national borders, but current cross-border payment solutions are slow, cumbersome, and opaque. Authorities in many jurisdictions, including the U.S., recognize the importance of cooperating across borders with each other and the private sector to address these considerable cross-border frictions. No doubt technology will continue driving rapid change in the way we make payments and the concept of money. The Federal Reserve remains confident in the power of technology and innovation to transform the financial system and reduce frictions while also preserving the important consumer protections, data privacy and security, financial stability, and monetary policy transmission mechanisms that have built up over many decades. Given the stakes, global stablecoin networks should be expected to meet a high threshold of legal and regulatory safeguards before launching operations. We are monitoring new technologies closely with respect to the implications for our operational responsibilities and broader public policy goals, and we are open to exploring new possibilities. We're upgrading our services to support innovation and payments, and we will continue to work to foster a safe and efficient payment system, including where money in all its myriad forms, present and future, is concerned. Thank you.
What?
Either way, which do you prefer?
Why don't you stand, if you will. Governor Brainard has kindly consented to take questions on the record. I'll play traffic cop if needed, but I'd like to recognize Professor Brunnermeyer to make the first comment or question as he chooses.
I just have one question quickly. So I was struck actually by Starbucks. You mentioned the example that they have 1.6 billion in terms of liabilities to customers in terms of credit cards, or in terms of gift cards. If Starbucks were to decide to liquefy these liabilities, what requirements, do you have any idea when the Fed would step in, or how would it intervene? At one point, would it intervene by saying, okay, you can freely transfer this cash you have for Starbucks liabilities from one customer to the next customer, you pay with your friends and all this. Would the Fed be concerned at this dimension as well?
So I think in the particular case, it's a closed network, and it's really the liabilities of a particular legal entity to a network of users that have signed up for it. So in that sense, it's more like a prepaid card, and we do actually have pretty good, as of recently, even better guardrails around prepaid cards. But that's conceptually how I would think about it. That's the closest analog.
Just the quick ground rules. When you're recognized, please feel free to speak. The more your comment resembles a question, the longer you can go, and vice versa. Please identify yourself when speaking, since the governor's on the record, so should you be. There is a traveling mic, which Patricia will bring you, and there's a standing mic in the back.
I would just amend that to say, feel free to filibuster.
Oh. Not something I expected her to say. Always surprising. Actually, next in line, though, is Martin Wolf.
So Martin Wolf from the Financial Times. I have two questions, very simple, I think, but not perhaps to answer. The first is, in the US case, how far do you think you need changes in law governing the regulatory structure to actually manage all the problems you indicate with these new players? And the second thing is, in particular, do you have the powers to determine whether specific organizations making radical proposals for a transformation of the system, let's say Facebook, is actually a suitable organization to do any of this? Because some of us think that's a pretty big issue.
So those are good questions. I laid out a little bit earlier the regulatory authorities that we do have across different regulatory bodies in the U.S., and the way that they are currently configured and the extent to which they may be applicable or they may be potentially insufficiently broad in some cases. And licensing authority in particular, our authority at the Fed is quite narrow. We really have oversight over certain supervised banks. As I said earlier, we do not have plenary authority over payment systems, which I think is a very important point. FSOC authority is a question mark because it is going to depend on the very specific facts and circumstances, and it's really with regard to financial institutions, financial activities. So the reality is that those regulatory authorities may or may not be adequate depending on how this entity and other entities decide to constitute themselves legally, which I think is still evolving and a little unclear. With regard to your second question, which is also a very important question, we really don't have that kind of authority. So it would really lie elsewhere. The other point, which I think is implicit in your questions, is any of these entities that start from day one with global scope and global scale require a tremendous amount of cross-border cooperation among various regulatory authorities in different jurisdictions. And each jurisdiction has different licensing authorities and different regulatory parameters, and that is one of the reasons that the G7 is spending a lot of time on this. This is something where we are at the FSB working a lot on this. It is inherently going to require a lot of cross-border cooperation with sets of rules that are quite different in different jurisdictions.
Thank you very much. James Fawcett from Morgan Stanley. I had, I guess, two questions to a little bit dovetail on your previous response. I guess, and maybe the impossible question, but how do you manage and work through the coordination of across all the different entities, both internal and internationally, particularly when for the large technology companies, it's become somewhat in vogue as a go-to-market just to launch without permissions or compliance with regulatory and deal with the consequences later, firstly. And then secondly, as it relates to the FedNow project, I guess the question is, why kind of start and build a new network instead of just taking advantage of a clearinghouse type structure, et cetera? Thank you.
So let's see. With regard to can you reframe the first question?
Yeah, sorry, disparate questions. The first is just like, what are the tools that the Fed and other regulators can put in place to coordinate, particularly when many technology companies are happy to launch without approvals, et cetera, and just deal with the consequences later?
Got it. So within borders, essentially, when activities have not sought particular licenses, but actually fall within the definitions of certain financial activities that are covered by financial regulations, they will get scoped in by the oversight of the relevant authorities. And that's what the discussions over the past several years, actually, starting with cryptocurrencies, have been about at places like the CFTC and the SEC. So when new activities arise, they may well fall under existing regulatory parameters according to the legal provisions, whether or not the innovators believe that or designed it in the first place. The thing that I think is really important, though, for that question and the previous question is just the reason the financial system has these safeguards that have been built up over decades is because there have been so many instances historically where financial panics have fundamentally disrupted economies and where consumers, households, and businesses have found that their financial holdings were not as safe as they had anticipated. And that is why we have these very important safeguards in place. With regard to FedNow, there are a few reasons. First of all, the Fed is the only entity that actually can facilitate real-time settlement between the accounts of banks directly. The private sector entity, by necessity, is a private ledger that is a joint account structure. And so if we don't build that capacity, it simply won't exist. And for purposes of resilience and for purposes of kind of future-proofing real-time payments, it's a very important function to build. Secondly, the Federal Reserve connects to 10,000 institutions, depositories, and other institutions around the country. The clearinghouse and its various payment systems often sits alongside the Fed and offers payment solutions in ACH and electronic funds transfer. So this would be the norm rather than a departure. But it's only the Fed that tends to make connections to the 10,000 institutions that facilitate payments. And we have the existing network and customer service built out, which is a lot of work to go that last mile. So we're really building on existing infrastructure in many respects.
Thank you. Next is everyone in the back. If you could go to the standing mic, please. Thank you.
Dion Rabowen from Axios. My question is just on the, I guess, the state of things or where we are at the moment. I just came from a presentation with David Marcus from Libra, and he seems to be putting forward the notion that they are ready to go kickstart things as soon as they can kind of get the approval. So I'm curious, where is the Fed with an example of, or with an actual presentable US digital currency? I've heard from some members of the Swedish central bank that they are around 5 years away. The Chinese central bank says they've got something to produce by November. So I'm just curious, where do you think we are with regard to actually having a Fed-produced or Fed-backed digital currency, and where do you see the rest of the world?
Yeah, so the two jurisdictions that you mentioned, and I think you'll get to hear from one of them on this panel, part of what is present in their payment system is there has been a very rapid migration away from cash to digital payments. The reverse has been true in the US. We have a lot of movement into digital payments, but we also have a lot of growth in the demand for cash. So we're in a somewhat different position, and I think we're also in a different position because of the nature of our sovereign currency and the role it plays more broadly. With respect to, as we think about the potential evolution of other jurisdictions and their consideration of central bank digital currencies, I think we will watch those developments very closely and look forward to learning from them. We will make important investments in future technology, for instance, to give the consumers the benefits of real-time digital payments. But we're also going to be exceptionally cautious and mindful of the profound differences a full-on central bank digital currency would imply along the lines that I outlined earlier in terms of consumers having accounts directly with the central bank, very profound implications for visibility into individual transactions data, implications for monetary policy transmission, and potentially for financial stability. So all of those things require a lot of careful consideration.
Really? Someone back there. Who's being pointed to? No? Okay.
You mentioned the speed of cross-border payments and the opaqueness of that process, and I guess it's also error-prone to some extent with SWIFT. Santander seems to be trying to approach it with a partnership with Ripple. Just curious what your thoughts are on that.
So I do think that of the use cases out there, cross-border is one of the most compelling. We know that intermediation chains cross-border are long and quite opaque, and they're slow, and they can be quite costly. So my sense is that technology with the appropriate safeguards could make a material impact and likely will. And it may well be through a partnership model. I don't want to pronounce on any particular approach, but there are a variety of partnerships out there that are trying to innovate and to reduce frictions and increase transparency for those cross-border transactions. In my sense, I'm fairly optimistic that there are some good solutions out there that don't necessitate a global stablecoin.
Other question? Please. Well, here. Sorry. Yep.
So following up on that a little bit,
Sorry, this was Frank Brosens from Takana.
Julia Coronado, macro policy perspective. So you laid out some of the issues and the challenges, and some of them seem like there are solutions to those. So for example, couldn't the Fed approach the two-tier system with digital currency with consumers, so that there's a payment system direct to consumers, that the Fed has the reserves, but it's through private sector providers, much as there's a two-tier system in the banking. Like, and you mentioned that the Fed doesn't right now have authority over payments providers. Does anybody have authority over payments providers?
So the way that our system works currently, and has for quite a long time actually, is that the Fed has been given authority to operate as a payments provider rather than to regulate and oversee payments providers, except the authority we have with respect to bank service providers in particular. So we do have capacity to provide those payment services. We currently do that through the intermediation of banks. Through the accounts that depositories and other institutions have with the Fed. One could think of other ways of doing it, but that's the way that we currently operate. And in terms of other regulators, FSOC has some authorities in that regard, but these would need to be determined to be systemic. The payments and settlement and clearing systems would need to be determined to be systemic with very particular statutory requirements. And again, it's not clear that those would be satisfied at this time.
But what about like the possibility of the Fed operating a two-tier system through a CBDC, like using the private sector, not necessarily maintaining all the accounts themselves?
So there are a variety of different ways to think about a potential central bank digital currency. We do, in fact, have a two-tier system in many respects right now, so that we issue digitally central bank money, and the intermediaries are the commercial banks that then provide those services to consumers. Some of the proposals, in fact, the large majority of the proposals that are out there that are really at the forefront of this discussion really mean moving to direct-to-consumer, direct-to-household account provision. So that's a really quite big leap from where we are today.
Please, if you could go to the microphone.
Brennan Greeley, also with the Financial Times. One of the chief arguments for stablecoins like Libra is that they improve digital inclusion or financial inclusion. Is that an argument that resonates at the Fed? And should the Fed be doing something in parallel to also increase financial inclusion?
So I think the arguments with respect to financial inclusion are also compelling, but it's also important to make sure that in the process of extending account access, that we don't end up providing accounts with little to no safeguards to those who don't currently have accounts. And so what really matters is whether in the process of expanding access to accounts and financial inclusion, that all households have the same kinds of safeguards in terms of their claims and the confidence that they can have that they understand the terms of their accounts and that they have the same kinds of assurances that other consumers have traditionally assumed with respect to bank accounts. So yes, I do believe that the financial inclusion objective is an extremely important one, but I also believe that those kinds of households also need safeguards and protections on their balances, perhaps even more than the current banked population.
Governor Brainard, if I could, on behalf of the international economics part of the Peterson Institute, can I pose a couple questions? You mentioned in your very excellent speech in passing about the huge private payment systems in China at the moment. And I was just wondering if in exchange with discussions with the People's Bank or the IMF or others, you think that there's any relevance of that experience, any things that would be more reassuring, less reassuring, or if it's unique. The second question, which may be more to some of your past roles, but we're currently aware of desires of various governments to get out from the potential leverage point that SWIFT and the US payment systems presents over them. Governor Carney sort of came at this in his remarks at Jackson Hole. We've seen the Russians recently announce they wish to create an alternative payment system to help the Iranians. At what point does the creation of these cyber currencies run up into those kinds of issues, if at all?
All right, so let me see. Going back to the first question. So actually, I don't know if you're going to have some discussion of the Chinese experience today on your panel, but I really think it's very instructive. I think the two big payments, the two big networks, which turned into massive payment systems in China, really do offer some really important lessons for the rest of us. And what those payment networks were able to do with the data that they had and the access they had, I think is very helpful in thinking about the potential benefits from being inside one of these networks and how these networks can grow very rapidly. And once those network externalities start to build, how they get somewhat locked in. And of course, they present some challenges to the monetary authority. And so I think that will be, that's a really important example, certainly in my own thinking. And I hope you'll be able to talk more about that here today. But the inherently global nature of some of these existing networks, I think, does explain why on day one, regulators across borders started speaking to each other. We do, in fact, have some ability to work across borders in regulatory supervisory colleges, for instance. And so we have developed these kinds of solutions for global systemic infrastructures before, and those are the kinds of arrangements that will be critical for some of these entities if they do satisfy the necessary regulatory and legal standards that I think they must. Second question. So one of the biggest benefits to many of the users of first generation cryptocurrencies was, of course, precisely that it was outside the regulated payment system and was opaque to money laundering and counter-terrorist financing authorities. And that kind of dynamic will remain. Of course, we have a tremendous amount of cooperation across a lot of jurisdictions in this shared objective. But I do believe that part of the reason that you see interest in some of the less opaque types of crypto assets is for illicit activity.
Is there a final question for Governor Brainard? Yeah, we've all got somebody else who's got a second bite at the apple first.
Thank you very much. I just wanted to ask a follow-up question here, and that was, obviously the U.S. position or the U.S. dollar position as a reserve currency has helped create a lot of demand for cash. One of the arguments that we hear around digital currencies issued by other countries is that the digital currency's distribution advantage, electronic distribution advantage, could serve as a path to unseating the U.S. dollar as a key reserve currency. What's your view in terms of that potential and relevance?
Yeah, so I think what is, I have to say what I have, and now I, may just step out of my Federal Reserve kind of perch for just a second and say, having observed the role of the dollar now over many decades, it is really notable. We've had massive changes in the international monetary system in terms of growth of certain economies, the emergence of other global currencies. It is notable how stable, in effect, the reserve currency's role has been. And I think historically, we also have seen that it requires a very unusual and low-frequency set of events to switch from an existing reserve currency to another reserve currency. The set of developments that we're witnessing today are another wave that raises those questions yet again. It certainly is something that I'll continue to watch carefully. It's not something, given our statutory and domestic responsibilities, it's not something that would change the considerations that we would bring to bear in thinking about the costs and benefits of moving to an entirely digital central bank currency.
Thank you so much. If you could please join me in thanking Governor Lael Brainard of the Federal Reserve. We'd like to invite those of you present with us today for a 10-minute break to accept our modest hospitality and our ample food for thought we already have. In 10 minutes, we will reconvene for a presentation by Marcus Brunnemeyer of the new study. I'll make sure I get the title right, The Digitization of Money by Brunnemeyer, James, and Landau, and then the panel moderated by Martin Wolf. Thank you very much.